What if there was a single investment that consistently outperformed over 90% of professionally managed funds over any 20-year period, charged you almost nothing in fees, required zero skill or expertise to use, and had more than 65 years of evidence behind it? You would probably say that sounds too good to be true. It is not too good to be true. It is an index fund, and it is the single most important investing concept that most people either do not understand or have been too intimidated by the name to look into. By the end of this video, you will understand exactly what it is, why the math behind it is so powerful, and exactly how to buy your first one this week. My name is Rich Future You. Subscribe if this is the kind of content you want more of.
Let me explain what an index fund is using the simplest analogy I know. Imagine a basket. Not a real basket, a financial basket. Inside this basket are tiny pieces of hundreds or thousands of different companies. Apple, Microsoft, Amazon, Google, Johnson & Johnson, Berkshire Hathaway. Every major company in the US stock market in proportion to their size. When you buy a share of an index fund, you are buying a tiny piece of that basket. When the overall market goes up, because companies in the basket collectively earn more money, grow their revenues, and create more value, your basket goes up too.
When the market goes down, your basket goes down. You are not betting on one company. You are betting that the overall economy keeps growing over time, which it has done, with interruptions, for as long as markets have existed. An index is just a list. The S&P 500 index is a list of the 500 largest U.S. companies. The total stock market index is a list of basically every U.S. company. An index fund is a fund that simply owns everything on that list. No picking, no predicting, no expertise required. Just own the list. Here is why the basket matters. When you buy an individual stock, say you buy shares of a single company, you are making a concentrated bet on that company's future. If the company does well, you do well. If it does not, if leadership makes bad decisions, if a competitor disrupts the market, if a scandal hits, if the industry shifts, your investment suffers. The history of individual stocks is full of companies that looked unstoppable and then disappeared. Kodak, Blockbuster, Sears, Enron, Lehman Brothers. Each of these was once considered a solid blue-chip investment. Individual stock picking requires correctly predicting not just whether a company is good today, but whether it will still be winning in 10 to 30 years. Almost nobody does this consistently well. An index fund solves this problem elegantly. If one company in the basket fails, it simply gets replaced by the next company that earns its spot on the list. The losers exit. The winners stay. You never have to make the decision. The index makes it for you. You own the whole market, and let it be what markets do over time, which is generally go up. The diversification of an index fund is not just convenient, it is the mathematical engine that makes it so powerful. Risk is distributed across hundreds of companies instead of concentrated in one.
Losers exit. Winners stay. You never have to decide.
Now here is the part that should genuinely shock you. Every year, thousands of highly intelligent, deeply experienced professional fund managers spend their entire working lives trying to pick stocks that beat the market. They have access to research, data, analyst teams, and technology that individual investors could never match. And over any 20-year period, more than 90% of them underperform a simple index fund. This is not a fluke. It has been studied exhaustively. The S&P Indices versus Active, SPIVA, scorecard has been tracking this since 2002. Year after year, decade after decade, the data is consistent. Active fund managers mostly lose to the index. Why? 3 main reasons. First, fees. Active funds charge significantly more than index funds,
often 10 to 50 times more in expense ratios. That fee comes directly out of your returns every year, regardless of performance. Second, the market is too efficient. With millions of highly informed participants all trading simultaneously, it is extremely difficult to consistently find mispriced assets before anyone else does. Third, compounding works against fees. A 1% annual fee sounds small, but over 30 years, it can cost you well over $100,000 on a typical retirement portfolio. So the professional fund manager is working against you in two ways simultaneously. Their selection decisions do not reliably beat the market, and their fees reduce your returns even when they are close. Let me show you the fee comparison in concrete terms, because this number needs to be felt, not just heard. A typical actively managed mutual fund charges an expense ratio of around 0.75 to 1.25% per year. A total market index fund from Vanguard, Fidelity, or Schwab charges between 0.015 and 0.6% per year. That is approximately a 20 to 50 times difference in annual fees. On a $100,000 portfolio, the active fund costs you $750 to $1,250 per year in fees. The index fund costs you $15 to $60 per year. The gap is $700 to $1,200 per year. Compounded over 30 years, the difference in your ending portfolio balance is not a rounding error. It is six figures. And remember, the active fund is charging you more whether it beats the market or not. You are paying for performance that statistically is unlikely to materialize over the long term. The index fund charges you almost nothing, and by definition delivers exactly the market return, which beats most active funds anyway. This is why Warren Buffett famously instructed the trustee of his estate to put 90% of his wife's inheritance into a low-cost S&P 500 index fund. Not a hedge fund, not a team of stock pickers, an index fund.
1. Total U.S. market. 2. S&P 500. 3. Total international.
Here are the
cover
three
the
index
entire
funds
world.
that consistently appear at the top of every evidence-based investing recommendation. I am naming these for educational purposes only. Always do your own research and consult a financial professional. Fund 1, a total U.S. stock market index fund. This owns essentially every publicly traded U.S. company, large, medium, and small. Maximum diversification within the U.S. market. Vanguard's equivalent is VTSAX or VTI. Fidelity offers FZROX with a zero expense ratio. Schwab offers SWTSX. Fund 2, an S&P 500 index fund. This owns the 500 largest U.S. companies. Slightly less diversified than total market, but virtually identical performance over long periods. Often the default option in 401k plans. Vanguard's equivalent is VFIAX or VOO. Fidelity, FXAIX. Schwab, SWPPX. Fund 3, a total international index fund. This adds exposure to companies outside the U.S., Europe, Asia, emerging markets, provides geographic diversification on top of the U.S. holdings, typically held alongside one of the U.S. funds rather than instead of it. Vanguard, VXUS, Fidelity, FZILX. For most beginners, starting with just a total U.S. stock market fund or an S&P 500 fund is completely sufficient. You do not need complexity to start building wealth. One fund is a valid starting point. Where you buy your index fund matters almost as much as which fund you choose, because the account type determines the tax treatment of your returns. Best option first, your Roth IRA. If you have earned income and are not over the income limit, contribute to a Roth IRA first. Your money grows completely tax-free, and withdrawals in retirement are tax-free. Open one at Vanguard, Fidelity, or Schwab. 2025 contribution limit, $7,000 per year under 50. Second option, your 401k, after capturing the full employer match. If your employer offers a 401k match, get that first. It is a guaranteed return. Then fill your Roth IRA. Then come back to the 401k for additional contributions if you have more to invest. Third option, a taxable brokerage account.
After maxing your Roth IRA and 401k, a regular brokerage account at Fidelity, Schwab, or Vanguard lets you invest additional money with no contribution limits, just no special tax treatment.
Account type determines tax treatment. First, aim for tax-free growth with a Roth IRA. Second, get your match for that free money. And third, use a taxable brokerage for no limits.
The most common barrier people cite to starting with index funds is not knowing enough. The second most common is thinking they need a lot of money to begin. Both are false. Fidelity and Schwab both offer index funds with no minimum investment. You can literally start with $1. Vanguard has minimums on some funds, but offers ETF versions like VTI and VOO that trade for the price of one share, currently under $250, with no minimum. The amount you start with matters far less than starting at all and staying consistent. A person who invests $100 per month starting at age 25 builds significantly more wealth than a person who invests $500 per month starting at age 35. Time in the market beats timing the market, and it beats waiting until you have the perfect amount to invest. The single most common and most damaging mistake new index fund investors make is selling during a market downturn. Index funds go down, sometimes significantly. In 2008, the US market dropped about 50%. In early 2020, it dropped
Selling in a crash is the only way to lose.
If you sold
Staying
at the bottom
invested
of
means
either
waiting
of those
for
events,
recovery.
you locked in your losses
How you win
and missed
is by
the recovery.
staying invested.
The entire logic of index fund investing depends on staying invested through downturns. Markets have always recovered from every crash in history. The people who lost money did not lose it in the crash. They lost it by selling during the crash. Do not be that person. Set up automatic monthly investing, stop checking the balance every day, and let compounding do what compounding does. An index fund is not a get-rich-quick scheme. It is a get-rich slowly, reliably, with almost no effort required scheme. It has 65 years of evidence, Nobel Prize-winning theory, and Warren Buffett's personal endorsement behind it. And it starts with $1 and 10 minutes of setup. The Index Fund Starter Kit in the description tells you exactly which fund to open, which account to open it in, what to type in the search bar, and how to set up automatic monthly investing so you never have to think about it again. Link below. Subscribe for a new video every Tuesday and Thursday. Reach future you. Own the market, pay almost nothing. Let time do the rest.
Own the market. Pay almost nothing. Nothing. Let time do the rest. Get the Index Fund Starter Kit for a rich future you.